welcome to today's webinar about the latest trends in ESG. My name is Aneta Buchert. I'm a Senior Director at the Global Institute of Credit Professionals, and it's my pleasure to be the host of today's session. The session today consists of two parts. The first is a conversation with our guest expert, and the second is the Q&A session. So if you have any questions, please do submit them via the Q&A functionality, and we will answer them at the end. So without further ado, let me welcome our expert, Armin Geltinger. Armin?
Thank you for having me, Aneta. It's a pleasure being here.
Armin, you are an ESG expert, head of ESG at Fitch Learning. Could you maybe start by telling us a little bit about your background?
Of course. I joined Fitch Learning about 2 years ago with the mandate to educate financial market participants about the importance of sustainability and ESG and how to actually integrate it into the business model, the processes, and the product offering. Prior to that, I worked roughly 20 years in investment banking, private banking, and asset management, both in Asia and in Europe.
Thank you, Armin. So ESG has been at the top of corporate agendas for quite a few years now, but there are always new trends, always new things happening. And from your perspective, Armin, as an ESG expert, what are the key areas in ESG that you're watching particularly closely right now?
I think some of the key new trends or new developments happening this year is first and foremost on sustainability reporting. We had two new almost global standards being published earlier in the year. So on the one hand side, we had the ISSB under the IFRS foundation, and that really will help companies not only publish their international accounting standards accounts, but also then their sustainability exposure and risk and opportunities. And then in the EU, we had the publishing of the final standards called ESRS, which then companies, again, based in Europe, have to start publishing from next year onwards when they are under the CSRD. So that's certainly one big area. In addition, I think just last month, we had the TNFD, that's the Task Force for Nature-Related Financial Disclosures, publish their guidance, their standards. So now companies, if they choose to, can report on their nature-related impacts. And that's certainly very new and interesting trend. And that leads me to the second big topic, which is really biodiversity, because we've come to realize that we're not only in a climate crisis, we're also in a biodiversity loss crisis, and we need to address that urgently, actually together, hand in hand with tackling climate change. And at the end of last year, we had the global conference in Montreal, COP15, that set out a global framework and agenda on how to address this very important topic. And I think now is the time for banks, investors, asset managers to look at how can they actually incorporate nature and biodiversity in their reporting and in their business models. So some very big new trends happening as we speak.
Very, very interesting and certainly lots of new things happening. I wanted to go back to a very traditional area of focus, which is renewable energy. What do you see happening in that space and how it's impacting in particular investors?
Yeah, I think in renewable energy, it's in many parts of the world, it's become mainstream. It's no longer niche. It's really reached a stage of critical mass. And I would even go as far as saying it reached a tipping point because the scale of generation capacity of building, and then hand in hand with that, the lowering of the cost. And when we compare the cost of different energy generation options, we see that in most or in many parts of the world, solar and wind energy is nowadays the most cost-efficient solution. So I would expect that we see even more of this coming up in emerging markets in other countries, and that's really helping companies, countries to lower their carbon emission and to create energy security. Now, with renewable energies, we have two challenges. That's really the transmission networks and how renewable energy can be connected, and secondly, the storage. Since we know the sun only shines half a day, and wind also doesn't blow all the time. So there are some challenges. And I think from an investor's point of view, it's important to understand these challenges, but also the benefits. We see a lot of policy support from governments around the world, so investors can take advantage of that. A lot of client demand. And addressing the challenges is really on making sure that your renewable energy project is connected to the grid, because otherwise you can't sell your energy. And if you're still investing in non-renewable, then obviously there is always the danger of stranded assets in fossil fuel infrastructure, and that's important for investors to keep in mind as well.
Thank you. That's really interesting. Now, closely related to this climate change, we couldn't cover ESG without talking about climate. So can you perhaps discuss the significant technological developments that are helping companies or countries make substantial strides in climate change mitigation?
Yeah, absolutely. I think so. On the one hand, definitely renewable energy and just generation of energy, of electricity, where we will need to see even more happening, but already nowadays we see about 80% of new generation capacity is in renewable. So this trend will continue and strengthen. But it's not only about renewable energy. It's then all the other sectors of the economy that we also have to decarbonize. Where we see already a lot of progress is in the land transportation. We talk about electric cars. Look at a country like Norway. I think 80 to 90% of new car registrations are already electric. Many other parts in the world see that really accelerating, that shift in electric cars. But it's not only cars; it's buses and trucks and vans that become based on electricity. And as long as that is generated with renewable sources, then it's really a major contribution. But it's not only that. We see now almost a resurgence of rail. So for instance, I think it was last month where for about the first in 100 years, a new long-distance train line was opened in the United States, in Florida, connecting Miami and Orlando with a new high-speed rail connection. And we see those projects in many, many different places around the world. So we see a shift there as well, moving away from maybe short-haul flights. And that will substantially contribute to reducing carbon emissions. And then, of course, we need to go to the other areas. Buildings have a large carbon footprint. So energy efficiency, retrofitting buildings and making it much more energy efficient is a key trend. And then things such as cement making, green steel, how can we decarbonize that? So there's a lot of promising new technologies and developments there as well. But I think mainstream is really energy and transportation, and we have the technologies today. We can use them already now.
That's really insightful. Thank you so much. So I wanted to move to the topic of ESG ratings. I think this may be of interest to a lot of people in our audience. But before I'd move to the ESG ratings, can we maybe start with actually discussing the difference between ESG ratings and traditional credit ratings?
Yeah. And that's a very important point you raised, because we need to make sure that when you use ESG ratings, you don't just compare them and take them as similar to credit rating, because they are very different and they're trying to measure something very different. So first and foremost, when you look at ESG ratings, it is important from whoever uses them, whether it's banks or investors, to understand what is this particular ESG rating trying to achieve. Because at the end of the day, different rating providers look at ESG very differently, and they assess materiality very different. So are we looking at what kind of financial impact do these ESG trends have to companies? So that's financial materiality. Or are we looking at impact materiality? So what do companies, organizations, how do they impact positively as well as negatively the environment and society? So we need to understand that. What do the users of ESG ratings try to achieve? And then make sure that you understand what the ESG rating agencies do, because they do it very differently and they use different methodologies. And that's why it's dangerous to just pick one or two of these and expect them to help you with the same thing. So a lot more analysis and a lot more homework is needed in this area, and obviously that we don't have that long track record yet compared to credit ratings, which have been around for 100 over years as well.
Thank you. And how do you see ESG ratings evolving, and in particular to accommodate the new understandings and expectations around sustainability and corporate responsibility?
Yeah. I think it is, the general public, investors, banks, they realize the importance of incorporating ESG because it just opens up the risk management framework to look at more than just pure financials. So that's certainly a good thing. But when you use the ESG ratings, that's just an attempt to condense all these various aspects into one single number or letter. When you look at the environment side, we have probably a dozen different topics. Are we talking about reducing climate or carbon emissions? Are we talking about biodiversity? Are we talking about pollution? Same on the social side. So it's sometimes it can be very, very tricky on understanding what do we try to achieve, and it's a very big umbrella that covers so much in ESG.
And probably a tough question, but can you elaborate on how strong ESG performance correlates with company performance, and in particular with credit risk?
Yeah, I think companies in general, when they have very high ESG performance, generally it means they're much more aware of the related risks within ESG and that the company faces. That means they have a better risk management approach. They're probably a bit more in tune what clients and customers might want in the future. They might be able to create new opportunities, new products and services that are demanded. So that, in a nutshell, generally correlates with a better managed company. And that ultimately helps with lowering your risk, your credit risk as well. Because we know from a credit perspective, the G factor, the governance, has always been a critical component of the credit analysis, and that continues to do so. But it's not only the governance aspect, but it's also how do environmental or social aspects impact companies' cash flows and business models and the long-term viability of that company. Because if it's not going in the right direction, we might face a default. So that's why it's a good thing to incorporate ESG risk analysis as well as just looking at the financials.
And I think you've touched on it already, but you've obviously discussed the credit ratings and the ESG ratings. So how are credit rating agencies integrating ESG factors into their evaluations, and what challenges are they facing?
Yeah. So the credit rating agencies have expanded their credit analysis to incorporate ESG, and a good example is really Fitch Ratings. So what they do with all of their credit rating reports, they have something called ESG relevance scores, and they then disclose on the issuer's profile on the report what kind of environmental, social, and governance risks are there, and how material are they to the industry and that particular company, and is there a possibility that those ESG factors then either positively or negatively impact the credit rating. And that just helps to understand the potential impact of ESG for issuers' credit ratings.
Yeah, and you've obviously not only have a lot of different ESG factors, you also have a lot of different industries. So how do you handle the discrepancies in the importance of ESG factors across the different industries when you look at their credit worthiness?
Yeah, that's a good point. ESG risks and exposure is not the same for a company in, let's say, the utility sector versus a financial institution versus a software company. So it is important to understand what kind of industry the company is part of, and then it helps us to use something called materiality maps. For instance, SASB has created one that is widely used in the market that helps to narrow down, okay, what kind of issues do companies generally face in an industry? So if you look, for instance, into mining or oil and gas, they obviously have a very big environmental impact. And on the social side, we see, for instance, having employee health and safety, because accidents unfortunately still happen there. But then you take a bank, employee health and safety is not the main concern within a bank, or for a software company, carbon emissions might not be the most relevant. So using materiality maps coupled with deep analysis and good research and creating your own assessment really helps to do that part.
Thank you, Armin. We've whizzed through a lot of really interesting subjects. Let me just move to the questions from the audience. We're very keen to answer any questions you may have. So if you want to ask a question to Armin, please do submit it via the Q&A functionality, and we will answer them right now. So let me see if we have any questions coming from the audience already. The first question is, how significant are the roles of smaller enterprises and startups in climate advancements compared to more substantial corporate initiatives?
Yeah, obviously in the public spotlight in the media, we hear and we read about big companies announcing new sustainability initiatives, new net zero targets and pathways, which is very important because obviously the bigger the company, potentially the bigger the impact there is. But I think it is also important that smaller, so SME companies start thinking about this if they haven't done yet. How can they incorporate sustainability into their business practices? Because ultimately this will lead to a long-term, more resilient business. And it also helps to be more in tune with what your customers might want. And many things can be done fairly easy, right? Switching to a renewable energy provider. Doesn't matter how big the company is. Or looking at, reusable packaging solutions. There's a lot that companies can do, and it's good business sense. It's not only doing good to the environment and to society, but I think it's becoming clear that it's just good business sense and strategy to have a more sustainable company and more sustainable operations.
Brilliant, thank you. And the next question we have is, what role do you see for renewable energy investments in reshaping energy markets over the next decade?
I think there is a big role when you look ahead in the next decade, and even I would say in the next 2 to 3 decades. We know we have to reach net zero globally by 2050. That's not that far away as it sounds, in order to stay within the 1.5 degree target set by the Paris Agreement. So we can expect that a lot more government-driven policies and regulations in order to cut carbon emissions come. Plus, another new trend is really climate litigation, which forces then companies or governments to become faster at reducing carbon emissions. And one main transmission channel is really the energy market, because that's really where the bulk of carbon emissions come from. So renewable energy is really the way forward, and we see some interesting new technologies also in terms of green hydrogen, biogas, and other solutions. So if I were an investor in the utilities, in the energy sector, I would look very, very carefully about the long-term viability if you invest in or if you operate new non-renewable energy assets. So I think this will continue to drive those energy market. But of course, short-term volatility in energy market is normal, and we still rely on fossil fuels largely at this moment. But if you project 10, 20 years into the future, I think it will look very, very different from today.
I think so too. Thank you for that. So the next question we have is, can you explore the discrepancies often seen between different ESG rating agencies, and how can investors navigate these complexities?
Yeah. I think we mentioned it previously. It is not the same as in credit rating agencies, because ESG rating agencies are also not regulated at the moment. It's probably coming in the next couple of years, but as we stand now, it's a fairly new field. It is not regulated, and we have a lot of different players in the market. So I expect also a bit more consolidation happening here. But the key is really, what kind of materiality are they looking at? As I said, is it pure financial materiality? Is it impact materiality? Or is it double materiality, which is both? And then you need to correspond that with the sustainability reporting frameworks. Earlier mentioned ISSB uses financial materiality, but when you look at the EU's, that speaks about double materiality. So it is very important to understand what are these ESG rating agencies trying to do, what kind of materiality do they use, and then choose the ones that are most closely aligned to the investor's objectives. I think that's really key, not to just expect them to all give you the same answer because they don't.
Yeah. And speaking of materiality, we actually have a question about it. So the question is, where can the analysts find a good source for the materiality maps?
I think SASB, so the Sustainability Accounting Standard Board, which is now part of the ISSB, they've produced a great materiality map that helps to navigate these various aspects, 25 to 30 different risk factors within ESG, and they also provide a lot of guidance for industries, because industries are different and their exposure to ESG is very different, and SASB really helps in that part of the analysis. So I can definitely recommend that.
Thank you. And so we've talked a lot about credit. Now we have a question about equities. So the question is there a correlation between ESG ratings and share price performance for listed companies?
Okay, that's a very common question. I think one of the misconceptions is that if you invest sustainably, if you integrate ESG, you automatically and immediately get a better return. But that's not really what ESG investing is about. It is about creating long-term value. And it's about risk-adjusted returns, and I think this is sometimes mixed up in the public debate, and one needs to be careful. But ESG trends, they play out over the long term. I mean, over years. So you cannot expect that in the next quarter or even within 1 year, your portfolio of high ESG scored companies will do automatically better. But I think if you are a prudent investor, if you want to manage your risks very well, and especially if you're long-term, right? If you're looking at your 5 or 10-year horizon, then it makes a lot of sense to look at companies that have higher ESG scores and ratings, because generally that is a good indication that the companies are just better managed. And there are also some opportunities out there to invest in companies with new technologies that prove to be very successful. And that will then also be reflected in the share price. But there is no automatic, I would say, causation. But what we can say is by investing sustainably, you will certainly not lose performance over the long term.
Brilliant, thank you. And moving back to credit, a question from Audrey. So does integrating ESG ratings into an overall credit risk internal scoring is a plausible approach to incorporate it into the overall credit analysis, or is it a too simplistic approach and the two ratings should be considered independently?
I think it should be integrated into one, because when we look at the pure traditional credit analysis, it's all driven by the financials, right? Cash flows, P&L, balance sheet. But ESG is affecting those things. It affects your cash flows, it affects your profitability, it can affect the valuation of corporate assets. So that's why I would always recommend to try to incorporate it within one analysis, because it is a risk. And if you extend loans for 5, 10 or longer periods, there are certainly these ESG risks that then might materialize during that time. So I would certainly say better approach. And we've seen that with some of our clients in the banks, how they approach it is to integrate it together.
Brilliant. So I have two more questions from the audience. If you have any more questions, please do submit them, and we will cover them with Armin. So Armin, the two more questions I have at the moment is, how might companies better align their strategies with ESG rating criteria without compromising their individuality and innovation?
I think one of the dangers is that companies only look at what is my ESG rating or my ESG score, and then how can I, make some changes in order to get a better rating. I think that's the wrong approach. Because first of all, you will always only, as a company, you will only look at one particular methodology, which might not be the relevant for your investors. So I think the right approach for companies is really, and the TCFD has done that very well for climate, to really take a multi-pronged approach. You look at governance, you look at strategy, you look at risk management, and then you look at metrics and targets. And I think this is not only applicable to climate risks and carbon emissions, but you can extend that to all other parts of material risks for your company in your industry. And that's what companies should focus on. How can you make sure you have the right governance in place? How can you integrate it into your business model and strategy? Because business and the economy is changing all the time. So I think it's a very positive, forward-looking way on managing companies. And then if you do the right thing and in the right way, then automatically, I would presume automatically your ESG ratings will improve. But that should be the progress, not the other way around.
Brilliant, thank you. And one more question. So what are the common pitfalls companies face when trying to improve their ESG ratings, and how can they avoid them?
Yeah, I think this is tagged with the previous question. I think it's important for companies to understand then their ESG ratings from different providers. Really see how do these analysts get to that result, and see if they can use it as an input for change. That's really key. But if you're just trying to change certain aspects and certain technical details in order to bump up your scores or your rating, I think that is a danger. You waste a lot of resources, time, and money doing that. But you should actually focus on what is the right business. Can you innovate, create, greener or more socially acceptable products and services, and listen to your customers. I think that's the key.
Brilliant. And let's finish off on that note. Armin, thank you so much. It's been fascinating. Thank you very much for your insights. Thank you everyone for joining us. It's been a pleasure to have you with us today.